A trading range is not a period of rest. It is a battleground of supply and demand. The range represents a critical equilibrium where the professional operator is executing a complex campaign. This operator is either accumulating inventory at lower prices or distributing holdings at higher prices. This process is deliberate, methodical, and often lengthy. Wyckoff analysis provides the essential framework to read the true intention behind the price action observed within the range. It allows the analyst to see the market through the strategic eyes of the Composite Man. The Composite Man is the controlling entity. It represents the coordinated action of all large informed interests. These interests work toward a singular financial goal, either accumulation or distribution. If the goal is accumulation, the Composite Man must systematically absorb all available supply from uninformed, weak hands. This requires patience and often involves driving the price lower to shake out sellers. If the goal is distribution, the Composite Man must systematically sell their extensive holdings to uninformed demand. This requires attracting buyers by creating the illusion of strength and rising prices. Before continuing, please subscribe and leave a quick comment. Even one word. This small action helps the algorithm show this content to more people. The entire structure of the trading range is governed by three fundamental Wyckoff laws. These laws provide the bedrock for understanding market dynamics. The first is the law of supply and demand. This law is simple but absolute. When demand is greater than supply, prices will rise. When supply is greater than demand, prices will fall. The trading range itself is a period where supply and demand are in relative balance. The professional operator works to shift this balance decisively. The professional trader monitors the tape constantly, looking for signs that the balance is tilting. Accumulation is successful when supply vanishes. Distribution is successful when demand is exhausted. The second core principle is the law of cause and effect. The lengthy period spent in the trading range is the cause. This cause determines the magnitude of the subsequent move, which is the effect. A wide, long consolidation phase builds a large cause. This large cause must, by law, lead to a correspondingly large effect, meaning a significant markup or markdown period. Small ranges yield small moves. Large ranges yield large moves. The analyst uses point and figure charting to quantify the cause built within the range. The third principle is the law of effort versus result. This law helps reveal hidden intention. Effort is measured by volume. Result is measured by the price movement or the price spread. If volume is very high, representing great effort, but the price spread is narrow and the market fails to make progress, representing a poor result, this signals conflict. During accumulation, high volume on a down bar with little price movement shows the Composite Man absorbing supply. During distribution, high volume on an up bar with little price movement shows the Composite Man meeting demand with selling. Effort without corresponding result is a key sign of manipulative action. Understanding the structure begins with identifying the range boundaries. These boundaries define the scope of the battle. The low side of the range is often initiated by the preliminary support or the selling climax. Preliminary support is the first substantial buying interest that temporarily halts a steep decline. The selling climax is characterized by massive panic selling. This event often sees the highest volume of the entire decline. It represents the final capitulation of weak holders. Immediately following the selling climax is the automatic reaction. This reaction occurs because the intense selling pressure has temporarily ceased. Professional buying, having absorbed the climax, allows the price to bounce naturally. The peak of this automatic reaction defines the initial upper boundary of the trading range. The high side of the range is marked by preliminary supply or the buying climax. Preliminary supply is the first substantial selling that slows a sharp rally. The buying climax occurs during a period of intense, often euphoric buying. This event is characterized by extremely high volume. It signals that the professional operator is meeting the public's demand with heavy distribution. Once these preliminary boundaries are set, the market enters the core consolidation phase. This is where the crucial work of testing and absorption begins. The first critical analytical event is the secondary test. This test occurs after the automatic reaction and is a direct measure of remaining supply. The secondary test attempts to retest the price level established by the selling climax. Its primary purpose is to confirm that the professional buying at the climax was successful in absorbing the majority of available supply. The analyst must observe two things during the secondary test: the depth of the penetration and the volume signature. Ideally, in an accumulation structure, the secondary test should hold above the low of the selling climax. Crucially, the volume on this test must be significantly lower than the volume seen during the selling climax itself. Low volume during the secondary test indicates that the aggressive supply that characterized the climax has been largely removed from the market. This is a strong early sign that the accumulation campaign is progressing according to plan. If the secondary test fails to hold the low, or if it exhibits renewed high volume on the down move, it suggests that supply is still heavily present. This often means the initial range boundaries were too high and the professional operator must adjust the campaign lower to find true support. The professional operator is methodical. They are constantly testing the market environment. These tests often manifest as repeated probes toward the extremes of the established range. In an accumulation scenario, the professional trader will systematically drive prices down to the lower boundary multiple times. These actions are designed to flush out latent supply and ensure the market is clean. When these repeated tests show a pattern of decreasing volume and decreasing volatility near the lows, it provides compelling evidence of successful supply absorption. The market is becoming tight. It is ready for the eventual markup. Conversely, during distribution, the professional trader pushes the price toward the high boundary. They are checking for remaining demand that they can sell into. If subsequent rallies toward the high boundary show decreasing volume, it suggests that demand is drying up. The public is losing interest or running out of capital. This signals that the distribution effort is nearing completion. Volume spread analysis provides immediate granular clues to professional intent within the range. This analysis is performed bar by bar. The analyst must look for high volume combined with narrow price spreads. This specific combination often signals absorption or distribution at critical levels. For example, if the price is declining into the lower half of the range on high volume, but the price bar exhibits a very narrow spread, it implies that aggressive selling pressure is being instantaneously met by equally aggressive professional buying. Supply is being absorbed, limiting the downward progress. If the price is rallying into the upper half of the range on high volume, but the price spread is narrow, it suggests that aggressive buying is being met by heavy professional selling. Distribution is occurring, preventing the market from moving higher easily. Conversely, wide price spreads on low volume near the boundary often suggest a lack of interest, meaning the range is unlikely to break yet. Wide spreads on high volume confirm the direction of the move, signaling commitment. The professional intent is revealed definitively during the final preparatory moves designed to mislead the public. These are the shakeouts. In accumulation, this final preparation is known as the spring. The spring is a decisive, manipulative move below the established trading range low. It is specifically designed to trap uninformed breakout sellers who believe the markdown has started. It also triggers stop-loss orders from weak holders who place their stops just below the known support level. The spring is only successful if the price quickly reverses and trades back into the range. This reversal must happen on strong expanding volume, confirming the professional accumulation. The move was a shakeout, not a genuine breakdown. In distribution, the comparable event is the upthrust or the upthrust after distribution. This move decisively breaks above the trading range high. It traps uninformed breakout buyers who believe the markup has started. It allows the Composite Man to sell the last of their inventory at inflated prices to the eager public. A successful upthrust quickly reverses back into the range, often on high volume. This reversal confirms that the move was a final opportunity for the Composite Man to complete the distribution campaign. Once the spring or the upthrust has occurred, the market is poised for directional commitment. The first major sign of commitment is the sign of strength in accumulation, or the sign of weakness in distribution. The sign of strength is a decisive move upward from the range. It often originates near the middle or the low. This move must be accompanied by expanding volume and wide price spreads. It shows genuine demand has overcome supply and is entering the market aggressively. The sign of weakness is a decisive move downward, exhibiting high volume and wide spreads. This confirms that supply has become dominant and is now driving the market lower. The final confirmation of the professional intent comes with the breakthrough of the critical boundary line established early in the range. In accumulation, this final event is called the jump across the creek. The price moves definitively above the resistance area established by the automatic reaction and subsequent secondary tests. This jump must be powerful and must hold. The market may then return for a final confirmation test, often called the backup action to the edge of the creek. This test should occur on significantly low volume, confirming that the resistance area has truly turned into a new support level. The markup phase has officially begun. In distribution, the final event is the break the ice. The price breaks decisively below the support line of the trading range. This signifies that the Composite Man has completed selling and is now allowing the price to fall. This breakthrough may be followed by a weak rally back toward the broken support line known as the last point of supply. This rally must fail on low volume, confirming the breakdown. The markdown phase has commenced. The successful Wyckoff analyst avoids predicting the outcome of the range. Instead, they patiently observe the volume signature, the behavior of the secondary test, and the final shakeout events. Trading range analysis is fundamentally a study of evidence. It is the disciplined process of confirming the Composite Man's intent before committing capital to the next major trend. The professional operator's true intent is revealed through three fundamental laws governing price action. These laws explain supply, demand, and the necessary balance between effort and result. The first is the law of supply and demand. When demand is greater than supply, prices must rise. When supply exceeds demand, prices must fall. Within the trading range, this law dictates the accumulation and distribution process. The market seeks an equilibrium, but the Composite Man is actively manipulating that balance to achieve a specific inventory goal. The second law is the law of cause and effect. The trading range itself is the cause. It is the period of preparation and inventory adjustment. The subsequent price trend, the effect, is proportional to the size and duration of the cause. A long, well-defined accumulation phase predicts a significant markup phase. The third law is the law of effort versus result. This law compares the volume, which is the effort, to the price movement, which is the result. If high effort, high volume produces little or no result, narrow price movement, it signals a conflict. This conflict usually means professional buying is absorbing selling pressure, or professional selling is meeting strong demand. This divergence between effort and result is a powerful signal of impending change. The Composite Man is the organizing force behind this entire structure. It is not an individual or a single firm, but a metaphor representing the coordinated actions of the largest professional interests. Every shakeout, every test, and every reversal within the trading range is attributed to the Composite Man's deliberate strategy. Before professional intent can be analyzed, the boundaries must be established. The trading range begins with dramatic, volatile action. In an accumulation scenario, the low boundary is often set by the preliminary support and the massive selling climax. The selling climax is characterized by panic, high volume, and extreme price volatility. This panic is often swiftly followed by the automatic reaction, which defines the initial upper boundary of the range. The distance between the selling climax low and the automatic reaction high sets the initial playing field for the Composite Man. In distribution, the high boundary is set by preliminary supply and the buying climax. The buying climax shows aggressive buying being met by professional distribution. This is followed by an automatic reaction downward, defining the initial lower boundary. Once the initial boundaries are set, the market enters the phase of detailed testing. The first major test of supply after the initial panic is the secondary test. This event is critical for assessing the Composite Man's progress. The secondary test attempts to revisit the price level established by the selling climax in accumulation, or the buying climax in distribution. The analyst must focus intensely on the volume and spread characteristics of this test. In an accumulation structure, the secondary test must show significantly reduced volume compared to the selling climax. Low volume on the secondary test means supply has been successfully absorbed by the professional buying. This confirms the initial low is likely to hold. If the secondary test occurs on high volume, it signals that supply is still heavy and the Composite Man has more work to do. The range may extend or the low may be broken in a later event. The secondary test often takes several forms. It might occur near the previous low, slightly above it, or even slightly below it. The location is less important than the volume signature. The volume must contract, confirming that the weak holders are gone. The professional operation involves repeated testing of the range extremes. This continuous probing is designed to confirm the absorption process. In accumulation, the price is repeatedly driven toward the lower boundary. Each successive test down should exhibit less volatility and lower volume. This pattern confirms that the supply available at lower prices is diminishing rapidly. It suggests the market is becoming dry. If the professional operator pushes the price down and it quickly snaps back on low volume, the test was successful. In distribution, the price is repeatedly pushed toward the upper boundary. If these pushes show decreasing volume and struggle to make new high points, it confirms that demand is drying up. The Composite Man knows the market is ready for the markdown when the rallies become weak, and volume contracts dramatically on the advance. Volume spread analysis provides contemporaneous clues to professional intent. Wide price spreads on high volume are usually indicative of a directional move, but within the range, context is everything. If the price falls quickly, showing a wide spread on high volume, but the move stalls abruptly, it signals professional intervention. That wide spread down was immediately met by powerful professional buying, preventing a collapse. Conversely, a wide spread up on high volume that immediately stalls near the top suggests professional selling is aggressively capping the price. Narrow price spreads on high volume are often the most telling sign of absorption or distribution. This suggests intense trading activity, high effort, but with little resulting price movement. The Composite Man is working diligently to either buy everything being sold or sell everything being bought. The accumulation or distribution phase culminates in a decisive shakeout. This move is designed to finalize the inventory position and deceive the public. In accumulation, this shakeout is called the spring. The spring is a move that momentarily breaks below the established support line, often penetrating the low of the selling climax or the secondary test. Its purpose is twofold. First, it forces out stop-loss orders from holders who bought early. Second, it entices short sellers into the market, providing the Composite Man with necessary liquidity to finalize their purchases. A successful spring must be immediately followed by a strong reversal back into the range. The reversal confirms the trap. Volume is key here. The move down often has high volume initially, followed by even stronger volume on the reversal backup. This reversal confirms the Composite Man is finished accumulating. In distribution, the parallel event is the upthrust or the upthrust after distribution. This is a decisive, momentary break above the established resistance line. It traps breakout buyers who anticipate the markup has started. It also allows the Composite Man to sell their remaining inventory at premium prices to the new demand. A successful upthrust quickly fails and reverses back into the range structure. This failure confirms that the move was purely manipulative. designed to clear the final resistance and complete the distribution. Following the successful spring or upthrust, the market is ready to show its true colors. The initial commitment move is the sign of strength for accumulation or the sign of weakness for distribution. The sign of strength is a strong, sustained rally, usually originating near the midpoint of the range, that breaks through minor resistance levels. It must be accompanied by expanding volume and wide price spreads, demonstrating that professional demand is now fully engaged. This is the first clear signal that the markup phase is approaching. The sign of weakness is the mirror image. It is a strong, sustained decline on high volume and wide spreads, confirming that professional supply is now dominating the market action. The ultimate confirmation of the Composite Man's intent arrives with the final breakthrough of the range boundary. In accumulation, this is the jump across the creek. The creek represents the final strong overhead resistance, usually the high boundary of the range. The price must jump across this resistance decisively, showing strong momentum and high volume. This signifies the transition from the preparatory phase to the execution phase. After the jump, the price often returns for a final confirmation test. This is known as the backup action to the edge of the creek. The backup action is a pullback to the broken resistance line, which should now act as support. Crucially, this backup action must occur on low volume, confirming that resistance has truly been overcome and supply is exhausted. The path for the markup is clear. In distribution, the final breakthrough is the break the ice. The ice represents the established support line. The price breaks decisively below this support, confirming that supply has overwhelmed demand entirely. This break is often followed by a short, weak rally back toward the broken support, known as the last point of supply. This rally should exhibit low volume and narrow spreads, failing to penetrate the old support line. This failure confirms the transition to the markdown phase. The professional trader understands that commitment is only warranted after the market structure has proven its intent through these specific volume-verified events. The Wyckoff method provides the necessary map to observe and confirm this evidence systematically. Confirmation is the final stage of trading range analysis. It is the moment the Composite Man reveals true intent. This critical stage moves beyond merely observing supply absorption. It focuses instead on definitive market commitment. The professional trader requires absolute certainty before deploying large amounts of capital. The most dramatic event in an accumulation trading range is the spring. It is the final preparatory action before the inevitable markup phase. The spring involves driving the price decisively below the established support boundary. This move is designed purely to shake out weak holders. It also traps short sellers who believe a true breakdown has begun. For a spring to be valid, the price must immediately reverse. It must trade quickly back up into the safety of the trading range. This reversal should occur on high or expanding volume. This rapid action confirms that the move was a deliberate shakeout. It was not a genuine collapse of demand. The successful spring clears the path for the market to advance. The counterpart in distribution is the upthrust. Sometimes it is called the upthrust after distribution. The upthrust drives the price decisively above the resistance boundary. Its purpose is to trap uninformed buyers who assume the markup has started. It also provides a final opportunity for the Composite Man to offload remaining inventory at elevated prices. Just like the spring, the upthrust must quickly fail. The price must immediately fall back into the distribution range. This reversal confirms the lack of genuine demand above the range high. These shakeout maneuvers are essential. They ensure that the maximum number of uninformed traders are positioned incorrectly just before the major move begins. Following the successful shakeout, the market must demonstrate directional commitment. This confirmation is the next required step. In accumulation, this commitment is the sign of strength. This is a robust upward move. It typically originates near the low boundary, often following a successful spring. The sign of strength must display clear evidence of professional buying. This means wide price spreads and significantly increasing volume. It signals that demand has overcome the residual supply within the range structure. In distribution, the comparable commitment is the sign of weakness. This is a sharp downward move. It follows a failed upthrust or a deep test of resistance. The sign of weakness confirms that supply is now dominant. It is characterized by wide price spreads and high volume on the decline. These moves are the first major indications that the cause, the trading range, is ready to produce its effect, the subsequent trend. The final stage of confirmation involves the definitive break of the range boundary itself. In accumulation, the resistance area is often referred to as the creek. The decisive movement above this resistance is known as the jump across the creek. The jump must be strong. It must penetrate the resistance line on high volume. The price must then maintain itself above the line. Following the jump across the creek, the market often performs a necessary final test. This is the backup action to the edge of the creek. The price returns to the newly established support level. This support level was the former resistance. This test must be conducted on low volume. Low volume on the test confirms that supply is absent at that level. The backup action turns the old resistance into new support. This final confirmation marks the official beginning of the markup phase. The professional trader can now commit capital with high confidence. In distribution, the final breakdown is called the break the ice. The price falls decisively below the support boundary. The break the ice must also be confirmed by high volume and wide spreads. It demonstrates the willingness of the Composite Man to push prices lower. A weak rally may follow the break the ice. This is known as the last point of supply. The price attempts a tentative return to the broken support line. This rally must fail quickly. It must fail on extremely low volume, and the failure confirms that demand has evaporated. The old support has become new resistance. This marks the official beginning of the markdown phase. The successful Wyckoff analyst avoids predicting the outcome of the range. Instead, the analyst patiently observes the behavior of the secondary test, the volume signature, and the final shakeout events. Trading range analysis is a study of evidence. It is the process of confirming the Composite Man's intent before committing capital. This systematic approach is not merely a technical checklist. It is a fundamental philosophy. It forms the foundation of what Richard Wyckoff defined as the business of trading. The analyst does not guess the direction. The analyst simply reads the actions of the professional operators. Every phase, from the selling climax to the final backup action, is analyzed using the law of supply and demand. High volume on a down move suggests supply dominance. Low volume on a down move suggests absorption is complete. The systematic observation of price, volume, and spread is the core discipline. Patience is paramount. The professional waits for the market to prove its intent. They wait for the confirmation events to complete. They do not enter on speculation. They enter only on clear evidence of commitment. Many of the principles discussed here, the necessity of reading volume, the requirement for waiting for confirmation, and the absolute focus on market structure, are detailed extensively in the foundational text. How I Trade and Invest in Stocks and Bonds. This text was adapted by Max Davidson. Wyckoff emphasized that trading must be treated as a serious business endeavor. It is not a casual gamble. The book stresses the importance of capital preservation above all else. It teaches the discipline required to ignore external noise such as breaking news or unsubstantiated tips. It mandates that judgment must be based solely on the market's own action. This means analyzing the specific price movements and the accompanying volume signals. Furthermore, the text sternly warns against fatal errors. It explicitly condemns the practice of averaging down losing positions. It highlights the absolute necessity of limiting risk through the use of protective stops. These risk management techniques are the necessary counterpoint to the technical analysis detailed here. They ensure that when the market gives a false signal, the professional trader's capital is protected. For those dedicated to adopting this professional analytical mindset, studying this original work is essential. It provides the psychological and mechanical rules required to execute the trading plan successfully. A link to how I trade and invest in stocks and bonds is available in the description below.